Welcome, everyone. The experts at My Tax Accountant have put this guide together to help you navigate a really critical topic for UK landlords, mortgage interest tax relief. We're going to break down all the current rules for the 2025/26 tax year, especially with the recent 2025 budget confirming how things stand. Let's kick things off with a pretty big question, one that's right to the heart of a massive tax change that's hit landlords hard. Are you paying tax on profit you're not actually making? Now, that might sound crazy, but for a lot of landlords right now, the answer is, unfortunately, yes. So how on earth did we get here? Well, over the next few minutes, we're going to walk you through it all. We'll start with the big tax shakeup itself. Then we'll explain the new 20% tax credit and show you how it really hits your bottom line. After that, we'll dive into the limited company option, weigh up the pros and cons, and wrap up by talking about what a personalized strategy looks like for you. Okay, let's get into it. There was a huge rule change. Officially, it's known as Section 24, and it has completely changed the game for how your rental profits are taxed. And just to be clear, the recent 2025 budget has confirmed that these rules are absolutely here to stay.
This slide really says it all. You see, the old way was simple, it made sense. Your mortgage interest was a business cost, so you deducted it from your rent, and you paid tax on the actual profit you made. But now, that's all gone. Your mortgage interest is no longer deducted, you're now being taxed on your turnover, your gross income, not your real profit.
So you're probably thinking, wait, if I can't deduct my biggest expense, do I get anything at all? It's a fair question. Let's move on and look at how this new system of tax credits is meant to work. And here is the absolutely crucial bit to understand. A tax credit is not the same as a deduction, not even close. A deduction lowers your taxable income, saving you tax at whatever your rate is, 20%, 40%, you name it. This credit, though, it's just a flat 20% discount off your final tax bill. And as you're about to see, that's a much, much worse deal for a lot of people.
So, here's the new process you have to follow. Step 1, you add up all your rent. Step 2, you take off your allowable costs, repairs, agent fees, but not your mortgage interest. That gives you your new, much higher taxable profit. And here's the trap. In step 4, HMRC calculates your tax on that inflated number, before right at the very end they knock off the 20% credit.
Okay, that's the theory, but what does this actually mean for your wallet? How does it play out in the real world for a landlord? Now stay with me here. This next part might genuinely surprise you. Let's look at a real-world example. Let's call him John. He's a landlord in London, and his other job makes him a higher-rate taxpayer. He gets £18,000 in rent and pays £8,000 in mortgage interest. You can see under the new rules, his taxable profit on paper has literally doubled, from £8,000 to £16,000.
And this is the bottom line. After that little 20% credit is applied, his final tax bill is £8,000. That's a whopping £1,600 more than it used to be. And remember, nothing has changed with his property. Same rent, same mortgage, same costs. The only thing that's changed is the tax calculation, and it's costing him big time.
But that's not all. And here's where a lot of people really get caught out. Because your on-paper income is now artificially inflated, it causes all sorts of knock-on problems. It can easily shove a basic rate taxpayer up into the 40% higher rate band. If your new inflated income tips over £50,000, you could start losing your child benefit. And if it goes over $100,000, you start losing your tax-free personal allowance, which makes the tax hit even bigger. It's a real minefield. I mean, just look at this quote. It sums up a situation that is now a reality for some landlords. It's now completely possible, especially if you're highly mortgaged, to be paying more tax to HMRC than you actually make in cash profit. Think about that. The tax bill alone can turn your profitable property into one that loses you money. So, with that pretty bleak picture, it's no wonder landlords are desperately asking, is there any way around this? Let's move on and look at the most common strategy that people are turning to as a possible solution. And here is the crucial difference. For properties owned inside a UK limited company, those Section 24 rules, they just don't apply. It's that simple. For a company, mortgage interest is treated as a proper business expense. It gets fully deducted from the rental income before any tax is calculated, just like the good old days. This chart just brings it to life, doesn't it? Let's say we have a portfolio making £20,000 in rental profit for a higher rate landlord. Owned personally, the tax bill could be around £5,800. But if that exact same portfolio was inside a limited company, the corporation tax bill would be just £1,900. The difference is, well, it's massive.
So looking at that, you'd think, right, problem solved. I'm setting up a company tomorrow. But hold your horses. It's not quite the magic wand it first appears to be. We need to look at the other side of the coin, because there are some really significant downsides.
You've got to weigh up those tax savings against some very real costs and headaches. Mortgages for companies are usually more expensive. There's a lot more paperwork, like filing company accounts. But the big one, the real killer, is that if you want to move properties you already own into a company, HMRC treats it as if you sold them, which can trigger absolutely massive, immediate tax bills.
And these one-off costs can be enormous. We're talking about the company having to pay stamp duty on the property's full value, and on top of that, you personally might have to pay capital gains tax on any profit the property has made since you bought it. For a lot of landlords with an existing portfolio, these huge upfront bills just make it a complete non-starter. Which brings us to a pro tip. To get around those massive transfer costs, a really popular strategy now is to take a hybrid approach. Basically, you leave your existing properties where they are, in your personal name, but you set up a new limited company to buy any future properties. That way, you get some of the benefits without the huge upfront costs. So, after all of that, what's the right answer? What should you do? Well, as you've probably gathered, it's complicated. There is no single correct path, and the best strategy for you depends completely on your personal situation. The right path for a high-rate taxpayer with 10 properties and big mortgages is going to be totally different from a basic-rate taxpayer with one property that's owned outright. You have to look at your tax band, how much you've borrowed, the size of your portfolio, and what you want to achieve in the long term. There is simply no one-size-fits-all answer here. And this is probably the most important thing to take away from all of this. You cannot guess. You can't just follow what your mate down the pub did. The only way to make a smart, informed decision is to actually sit down and run the numbers for your specific circumstances with an expert. You need to model it all out to see which option truly benefits you. To navigate these really complex rules and build a tax-efficient strategy that's tailored for you and your property investments, we really recommend you speak with the experts. You can get in touch with my tax accountant directly on 0208-570-8531, or you can email them at info@mytaxaccountant.co.uk. And finally, just a quick but very important note. This is a complex area of tax, and the information we've shared is for general guidance only. It shouldn't be relied upon to make your financial decisions. Before you take any action at all, you absolutely must consult a qualified tax expert at My Tax Accountant to get professional advice that's tailored to your unique circumstances.